All right, there is a market rule of thumb that when interest rates back up, it is not good for the cyclical industries. So a lot of the stocks that dominate the Dow, that's where the Dow really feels it on the chin when something like this happens. But particularly auto stocks, which have been getting hammered, and really particularly home building stocks, all the big home builders, anyone having to do with that in the finance arena. There are a couple of ways to play this. You're looking at the iShares index, which looks at home construction. It's an exchange, a trade-weighted fund, and that, of course, is down in excess of 20% this year, well into bear market territory. The same with the spiders on the S&P home building ETF, down about 22% year to date. Again, that shows you what was building as interest rates went up and it became more difficult for a lot of folks to afford a home, even though the rates are still historically low. The effect was real, and we've seen it in auto and auto-related stocks as well. In fact, that whole sector, although not to this degree. So what to make of that? The first real tangible evidence of the effect of a backup in interest rates. Let's go to Market Watchers, Jim Lacamp, Keith Fitz-Gerald. Keith, what do you think of what's going on in housing and in that arena? Does it presage trouble for the market, or is it an anomaly?
I don't think it's an anomaly, Neil, and here's why. You know, they've got obviously the interest rate pressure, but don't forget these are also things that have huge raw input costs. So the cost of wood, the cost of all the materials that goes into it, homeowners traditionally, or home builders have traditionally not been able to do a lot of margin protection. They're pretty much at the whim of the consumer, and if the consumer's not buying, it's a one-way ride to the house.
Jim, if it's riding south now, you could make the argument, well, we'll continue riding south because the Federal Reserve has made it clear we're going to keep hiking rates. We're behind the curve on this, so we have a long way to go for neutrality, to put it more succinctly. So if it's inhospitable now for housing stocks, it's going to get only more so, right?
It depends on what you think is going to happen with the 10-year Treasury yield. Remember, Neil, in 2004 to 2006, the Federal Reserve Board raised rates 17 times. The 10-year Treasury yield didn't really move very far. We've had this bump up now, but the reality is, and the economy is doing very well, this doesn't mean we're going to just keep going up. Even if the Fed raises rates, we could see the 10-year yield back down. The bigger issue is that we had 0% interest rates forever. So what does that mean? It pushed up stock prices, bond prices, it pushed up collectible cars, and it pushed up real estate values to the point where a lot of people said, I don't want to buy at that price. At the same time, we haven't seen those prices come back down to where demand is. Millennials haven't made enough money to where they could afford a new home. So we've got all these forces that just suggest that some price adjustment needs to be made, and it suggests that it may be a while. I do think that the cost input is a big deal here as well. So these are all forces that stagnate the housing market. But remember, housing stocks had a great year last year. This year they're coming back, and the reality is this industry group is lagging, has been lagging all year, but it's a moving picture. I do think more adjustment has to be made. I don't expect that it means we're going to have a long-term bear market.
Okay, Jim, thanks for reminding folks, too, when it comes to the 10-year, no, that is not a rate at which the Federal Reserve can peg. It can peg short-term, rates and, the overnight bank lending rate, which affects clearly the one-year bill and the two-year note, what have you. But it has virtually no control over what the market perceives to be an inflation threat or lack thereof. So accepting that at face value, Keith, we could be seeing a flattening yield curve again without getting overly wonky, that short-term interest rates continue their rise. Longer-term rates, despite the puncturing to 7-year highs, could sort of settle a little bit, not move as aggressively as what's happening on the short end. And that could portend a slowdown. Do you agree with that?
I do, absolutely, Neil. And not to get all wonky, but to put it in very simple terms, the yield curve is like a seesaw, and the 10-year is kind of a pivot point. So when you have a market this way or that way, it really doesn't matter. What's happening is it's flattening out, which means there's going to be some settling. That's a normal function of trading. That's a normal function of interest rate assessment. It is flattening.
I know what happens when it's the reverse and shorter-term rates are higher than longer-term rates. Almost always it's recessionary or will be. When it's flattening, though, at worst, it can portend just sort of like a flat economic environment to mimic the curve itself, right?
Well, it can, but don't forget, as long as the earnings continue to be good, we're seeing things we just simply haven't seen in a generation. That tells me that there is still more money coming in, and a rising tide raises all boats, even if there's not a lot of wave activity. So at least something to think about why you want to be with the best companies as opposed to the worst ones right now.
Jim, there's another argument that's been made, I believe in the Wall Street Journal. I think the Financial Times had picked up this theme a couple of weeks ago, that a rising rate environment can affect multiples on the market. And obviously, the more it rises, those earnings end up not being as good as they would normally be. In other words, it changes the equation a bit. Are you worried about it changing the equation to the point that it dramatically affects earnings, maybe not in the quarter just completed, but in the quarters to come?
It does change things. Remember that a lot of the earnings have come from share buybacks and mergers and acquisitions, and as interest rates rise, it impacts what you can do there. You can't borrow money as cheaply to buy those share buybacks. Secondly, you have CD yields rising a little bit, and that on-the-fence investor may be buying a few CDs for the first time in years. I doubt that's going to be a big thing. I think the bigger issue, Neil, is that the economy is growing faster. The GDP is growing faster than the level of interest rates. And corporate earnings are growing faster than the market has been growing. And the economy looks very strong. If you look at the ISM, both the service and the manufacturing side, combine those things for last week, you had the strongest reading in years. So the economy is still doing very well. Wages are growing. And this is another reason why I'm not calling for the death of the housing market. People are working. Wages are growing. They're spending a little more money. I think the housing market eventually will be okay. It may have some short-term pressure. But beyond that, I think these rising long-term yields do have an impact. I don't think they overrule this entire set of tailwinds that the market has had with earnings, with economic growth, with employment trends very strong.
Gentlemen, thank you both very, very much. Good reads on what we're seeing right now.